It's Brian Preston, the Money Guy.
15-year versus a 30-year mortgage.
Yeah, Brian, I remember this is something that, when we first started working together, we used to really preach 15-year mortgage is hard. I mean, we used to say it just made sense. Get out of debt really quick. You can accelerate. You look at how much interest you'll save over the whole life with a loan. We used to tell people, do that, 15, 15, 15. We would drive that home if your cash flow could support it.
And now look, and this could evolve again, because I will tell you that some of that is sensitive to where interest rates are.
Yep.
My first mortgage on my very first house I ever bought was 6 3/4.
See that, right now, that sounds so high. 6.75% sounds like an insane mortgage rate.
If I could tell you, I celebrated that I got 6 3/4 because it wasn't probably 6 months earlier. It was like 7 1/4. So, and I will tell you that. So it makes sense when that is where rates are. Saving that 0.5%, because that's what 15-year versus 30 years. There's typically about a 0.5% interest rate difference between them. That can be a big deal. But we are in right now a historically super low interest rate environment. So I think it's okay to do a 30-year mortgage instead of a 15-year. And you're probably like, well, why? And I want to give you my experience with the 15-year mortgage. This is actually from my life, what I experienced. And I'm not a debt crusader, but I am definitely a person that how you've seen my finances. I don't like debt.
Right.
I mean, contrary to what all you people in YouTube comment section say, I do not like debt. I don't do credit card debt. I mean, I pay it off monthly.
Right.
I don't have any car loans. The only debt I have on my house is a mortgage, and it will be paid off in less than 10 years from when I took out that first mortgage on my brand new house.
So that means you took out a 10-year mortgage, right?
No, I took a 30-year mortgage.
Okay.
So, because let's talk about it, because that's the 15-year mortgage. Here was my experience. I did have one 15-year mortgage in my life, and it was on my second home. And the problem I had with it is that here's the situation I ran into. Fourth quarters are tough for me. And maybe it's because I'm a small business owner. A lot of you who are small business owners, you're going to know what I'm talking about. Fourth quarter, guess what happens? You have to pay Christmas bonuses to all your employees because they expect Christmas bonuses. You also have to renew all of your insurance, all your software. All that stuff comes due at the end of the year. And then and then you have Christmas for your own family. You're trying to buy gifts and be prosperous for your family. And you realize, holy cow, for somebody who is tight with their money and disciplined with their money, I am just out.
It gets
lean. It is really lean through that fourth quarter. But then you get into the first to second quarter of the year, it feels pretty flush. You're like, this is weird that I'm self-creating this weird period in the fourth quarter where I feel completely broke. Now, look, cash reserves are out there. I don't want you guys going, well, cash reserves, that's it. Yes, but there's still a psychological benefit. I mean, fear when you see how lean you're running it in that fourth quarter. And then here's the other part. So not only do you lose flexibility on your cash flow, but second, when it was time to sell that second home and I was making my transition here to Tennessee, you saw the valuation earlier in this show. I got crushed. And because I had a 15-year mortgage, it was really squeezing what I qualified for because, look, that house didn't sell easily. So I had to carry. There was a period of time, years, that I had to own two homes. I owned my house in Atlanta and I owned my house here in Tennessee. So I'm just telling you, if you think you're going to get in some type of situations like that, it can have difficulty when you're locked into a 15-year. You might want more flexibility in what you're doing. So that house is sold now. It's all good. That's the rest of the story. But I think you can learn from that experience. So, Bo, let's go over some Money Guy teachable tips.
Yeah, I was going to say, so what is our recommendation in terms of how you approach mortgages and paying off mortgages? And Brian, I don't know. I don't remember when this happened, but one day I think you just woke up and you came up with a number, but it's just such a good number. You finally said, look, there's a dividing line. If you're on this side of the line, do one thing. If you're on this side of the line, do something different.
And it's all driven by the fact of compounding growth for your retirement assets and what you can expect, but also try not to take too much risk that you don't run the whole enterprise into the ditch. So there's a balance there. And I think anybody under 45, you're really it doesn't make sense, especially in an interest rate environment like right now, where you can get a 3.5% to a 4.25% interest rate. There's no reason to go prepay all that stuff while you could have growing assets that you'll need for retirement. But then when you get over 45, I think that it's okay. You want to simplify. Your life is changing. The compounding growth effect is not as powerful as it was when you're 25 years old. Why not get out of debt completely? And look, I had this discussion just a few days ago. Somebody said, why would you ever pay your mortgage off? And I was like, it's not a numbers point. At that point, there is a point where you go cross over from a psychological standpoint, from a peace of mind standpoint. That's why you want to own your life at retirement, is because the word encumbrance, which debt is, does not go at all with financial independence. How are you independent when you have something that is encumbering and creating an obligation for you?
And I think sometimes, Brian, I get caught in this trap of stuff that's common sense to me, I recognize is not always common sense to the people that I'm around. I've had this conversation 4 times in the last month, talking with young folks who've had a desire to prepay their mortgage. And I say, I think it's great if you want to get out of debt and do that. But by putting the money on the mortgage and satisfying the mortgage, you may not be doing yourself any favors, because you still have the ability. If you say, you know what, I want to pay off my mortgage in 10 years, you could still save that money outside of paying off the mortgage, build up an after-tax account, and then if you so chose 10 years from now, you could just write a check and pay off the mortgage.
Yep.
What it does is it leaves maximum flexibility in your corner, because once that dollar goes into the mortgage, we just saw what happened to you in 2000. It's hard to get that dollar back out, especially if there's some sort of downturn.
I want to go a little deeper, because if I had a house, I showed an example earlier. If you're watching a highlight instead of the full show, if you go watch the full show, I showed that my house at the end of 2006 back in Georgia was worth $510,000, but just 4 short years later, less than 4 years, it was like 3.5 years, it was worth $270,000. So all that equity kind of evaporated. So think about this in terms of, if you were prepaying your mortgage, if you're a 25 or 30-year-old or 35-year-old who's just dumping money to get debt-free, you don't really get the benefit of flexibility of saving that monthly payment until it's completely debt-free.
That's right.
If it's going to take you 10 years to hyper-aggressively pay off that mortgage, but you lose your job in year 6, it's not easy to go pull all
That's
that
right.
6 years of aggressive payment back out. You'd probably be better served from a flexibility if you had that money in something liquid, like an investment account. And if it's a diversified investment account, you probably wouldn't have to go yank all of it
That's
from
right.
equities that are down. You might be able to go pull some of it from conservative assets to bridge getting over the life stuff that just happens.
Yep.
So we probably beat on that horse a little bit, but it is one of those things. And remember, I'm reserving the right that interest rates could change this. If we have a spike in interest rates where people are paying 7 and 8% on mortgages, we'll evaluate it. But right now, interest rates are super low. Don't go get in a hurry if you're under 45 paying it down
I'm
fast.
chuckling thinking about maybe like eight years from now when we redo the show or something, and we're gonna go back and be like, remember that time we told you 15 verse 30? We had to change. It's just funny full circle.
That's the cool thing about
I
having
went Seinfeld
videos.
with it.